For 9 days, one of the most important price discovery centers in the world was silent. No bids, no offers, no physical clearing. The Shanghai Gold Exchange, the primary gateway for physical precious metals, demand in the largest industrial economy on Earth, was closed for Lunar New Year. And while it was closed, something happened. Western paper markets crashed silver. On February 17th, during thin liquidity, silver was driven down to $72.62 per ounce. A violent move. Fast, aggressive, and largely driven through futures contracts. Not trucks moving metal, not refineries shutting down, not mines suddenly producing more silver, just paper changing hands. For 9 days, Shanghai watched from the sidelines, and then it reopened. And then, in a single moment, it revealed something the paper market could not hide. Shanghai opened silver at $88.24 per ounce. At that exact same time, Western spot silver was trading around $78.86. That is a $9.38 premium, an almost 12% difference. Pause and think about that. The same metal, the same atomic element, two different prices, separated by nearly $10. This is not normal. In functioning commodity markets, price differences between major exchanges are usually small, $2, maybe $5 at most, and they close quickly through arbitrage. But this was not $2. This was not $5. This was nearly $10, and it happened instantly. The moment Shanghai reopened, the physical market spoke, and it spoke loudly. The crash that physical buyers rejected. To understand why this matters, you have to go back to February 17th. That was the day Western paper markets forced silver down to $72.62. There was no global mines suddenly flooding supply. There was no collapse in industrial demand. There was no technological breakthrough replacing silver in solar panels, electronics, or electric vehicles. What there was thin liquidity and heavy paper selling. In futures markets, price can move dramatically without a single ounce of physical metal changing hands. Contracts can be created, sold, bought back, rolled forward, all without delivery. So price becomes a reflection of positioning, not necessarily availability. But when Shanghai reopened, physical buyers had the opportunity to respond. And they did not accept $72. They did not accept $78. They immediately bid silver above $88. That is the difference between paper liquidation and physical demand. Paper can move price temporarily. Physical demand determines where it settles. The meaning of a near-record premium. A nearly 12% premium is not a routine fluctuation. It is a signal of urgency. It means buyers were willing to pay significantly more than the global reference price to secure real metal immediately, not next month, not next quarter. Now, in commodity markets, premiums emerge when supply is tight relative to demand. When inventories are abundant, buyers demand discounts. When inventories are scarce, buyers pay premiums. Premiums are not emotional, they are economic. They reflect scarcity. And when the largest physical demand center in the world opens with a near-record premium, it raises a critical question. Was the Western price collapse real? Or was it simply a temporary dislocation created by paper markets operating without physical confirmation? Because the moment physical trading resumed, price snapped higher. Not gradually, immediately. That tells you something fundamental. The physical market did not validate the crash. It rejected it. The clock is ticking. Only 72 hours remain. And this event did not happen in isolation. It happened just days before one of the most important deadlines in the silver market. COMEX, First Notice Day. First Notice Day is the moment when futures contracts stop being theoretical. It is the moment when short sellers must declare whether they will deliver physical metal or close their positions. Until that moment, a futures contract is simply an agreement. After that moment, it becomes an obligation. And right now, there are hundreds of millions of ounces in open contracts. While the amount of registered silver, the metal actually available for delivery, is far smaller, COMEX currently holds roughly 88 million ounces of registered silver. Just 2 weeks ago, that number was over 103 million ounces. 4 months ago, it was dramatically higher still. Nearly half of the deliverable inventory has disappeared in recent months, not because silver stopped existing, but because it was withdrawn, moved, delivered, locked away, removed from exchange availability. At the same time, open interest for the March contract represents somewhere between 230 million and 358 million ounces of paper claims. That creates a paper-to-physical ratio between 4 to 1 and 6 to 1, meaning for every ounce available, there are multiple ounces promised. This system functions normally when most traders roll their contracts forward instead of demanding delivery. But if more participants choose delivery, the math becomes tighter. And now Shanghai's premium changes the incentives completely. The drain is still happening. Every single day, silver continues leaving registered inventory at an average rate of roughly 785,000 ounces per day. By the time first notice day arrives, registered inventory could fall to around 86 or 87 million ounces. Every day that passes reduces the buffer, every withdrawal increases pressure, because futures contracts represent claims, but registered inventory represents supply, and the distance between those two numbers is the margin of safety. Why Shanghai changes everything. The Shanghai premium creates a new reality. If physical silver is worth $88 in Shanghai, and futures contracts allow delivery near Western prices, industrial users suddenly have an incentive to stand for delivery. Instead of rolling contracts forward and hoping price remains stable, they can take the metal now, secure supply, and potentially arbitrage the difference. This is how delivery pressure builds, not through speculation, but through economics. When physical metal is more valuable elsewhere, demand shifts toward delivery, and every ounce delivered reduces exchange inventory further, which increases pressure on remaining supply, which can increase premiums even more. It becomes a feedback loop. The market is approaching a decision point. For years, paper markets and physical markets moved together. Futures prices reflected physical supply and demand reasonably well, but events like this expose the fragility of that relationship. When a major physical exchange opens nearly $10 above paper price, it forces a reconciliation. Either physical premiums collapse, or paper prices rise to meet them. And that reconciliation often happens fastest near delivery deadlines, because deadlines force decisions. Short sellers must deliver or exit, buyers must roll or stand. There is no indefinite delay, only resolution. And with just days remaining, the silver market is approaching one of those moments. Now, the most important question becomes simple. How many of those contracts will actually demand silver? Because the answer to that question determines everything. Not headlines, not opinions, not predictions. Math. Let's start with what already happened. In February 2026, nearly 98% of open silver contracts resulted in delivery. Think about that for a moment. Almost everyone who held contracts chose to take the metal instead of rolling forward. That translated into over 18 million ounces physically delivered. That is not normal behavior in futures markets. Futures markets are designed primarily for hedging and speculation, not delivery. Most participants roll contracts forward. They close positions, they settle financially, they do not take trucks full of metal. But recently, that pattern has changed. And January 2026 made that clear. In January, over 49 million ounces of silver were delivered. That was more than 7 times higher than the delivery level from January just 2 years earlier. 7 times in just 2 years. That is not gradual change, that is acceleration. And it tells you something important. Participants are no longer treating silver futures purely as trading instruments. They are using them to acquire real metal. And when delivery demand accelerates, inventory becomes the critical variable. Because once inventory is gone, there's nothing left to deliver. Scenario 1. The system holds. Barely. Let's start with the most stable outcome. If around 4,000 contracts stand for delivery, that equals roughly 20 million ounces of silver. COMEX could handle that. Inventory would fall from around 87 million ounces to roughly 67 million ounces. The system would survive, technically. But survival would come at a cost, because inventory would be significantly reduced. Buffers would shrink. Future delivery months would begin with less available supply, meaning each successive delivery cycle becomes more fragile. This scenario represents stability on the surface, but deterioration underneath. The system continues functioning, but with less margin for error. Scenario 2, system stress. Now consider a more aggressive outcome. If 10,000 contracts stand for delivery, that equals approximately 50 million ounces. That would reduce inventory to roughly 37 million ounces. At that level, the exchange still functions, but confidence begins to weaken. Because the cushion protecting the system becomes extremely thin, participants start asking harder questions. How much metal is really available? How many more delivery cycles can this continue? How much demand can inventory absorb? And price responds to those questions. Historically, when inventories tighten dramatically, prices rise, not gradually, but rapidly, because buyers compete for limited supply. In this scenario, silver prices could move into the $95 to $110 range, not because of speculation, but because of scarcity. Scenario 3, structural failure. Now consider the most extreme possibility. If 16,000 or more contracts stand for delivery, that represents over 80 million ounces. That would approach or exceed total registered inventory. At that point, the exchange faces a fundamental problem. You cannot deliver metal that is not available. And when supply cannot meet contractual obligations, rules change. Settlements may be offered in cash instead of metal. Delivery timelines may be extended. Emergency measures may be implemented. This is not theoretical. Commodity exchanges have adjusted rules in the past during extreme stress, because exchanges exist to maintain order, not to guarantee unlimited physical supply. In this scenario, price would likely react violently. Silver could move into the $120 to $150 range, or higher. Because the moment confidence in deliverable supply weakens, physical metal becomes dramatically more valuable, not as an investment, but as certainty. Why Shanghai's premium makes delivery more likely. Now remember what Shanghai just showed the world. Physical silver trading nearly $10 above Western paper price. That changes behavior immediately. Imagine you are an industrial manufacturer. You need silver for solar panels, electronics, electric vehicles, medical equipment. You hold a futures contract that allows you to take delivery near Western prices. Meanwhile, Shanghai is already pricing silver significantly higher. What do? You stand for delivery. You take the metal now. Because waiting introduces risk, rolling contracts introduces uncertainty, but taking delivery guarantees supply, and that is the key shift happening right now. Participants are prioritizing certainty over flexibility because premiums signal tightness, and tightness creates urgency. Institutions are already moving directly to the source. This shift is not theoretical. Major corporations and financial institutions have already begun securing long-term supply agreements directly with miners, bypassing exchanges entirely. One of the largest precious metals streaming companies committed over $4 billion to secure 555 million ounces of silver over the next 25 years. Not next week, not next month. 25 years. That is not speculation. That is supply security. At the same time, major industrial firms have entered agreements to lock up entire mine production streams, prepaying millions of dollars, ensuring guaranteed access. Why? Because relying solely on exchange inventories introduces uncertainty. Direct agreements remove that uncertainty, but every ounce secured directly from miners is an ounce that never reaches exchange inventory, which tightens supply further, which increases pressure on remaining inventory, which increases the importance of delivery cycles. It becomes a self-reinforcing dynamic. This has happened before, and the outcome was clear. There is a historical parallel. In 2008, during the global financial crisis, gold experienced a similar divergence. Paper prices fell sharply, but physical demand surged. Premiums exploded. Retail buyers could not find coins. Delivery delays stretched for months, and eventually, paper prices rose dramatically to match physical reality. Gold moved from around $800 to nearly $900 within 3 years, more than doubling, not because gold changed, but because price finally reflected supply and demand accurately. Today, silver faces a similar structural environment, except with one critical difference. This is not a temporary shock. Silver has been in a physical supply deficit for years. Global demand has exceeded supply repeatedly. The cumulative deficit since 2021 has reached hundreds of millions of ounces, nearly an entire year of global mine production. That deficit does not disappear overnight. It accumulates quietly until something forces adjustment. The next 72 hours matter more than most people realize. Everything now comes down to observable data, not speculation, not emotion. Data. Watch open interest. If open interest falls sharply, it means contracts are rolling forward. Pressure decreases. If open interest remains high, it means delivery demand remains strong. Watch lease rates. Lease rates represent the cost of borrowing physical silver. Normally, they remain low, 1 to 3%. But when supply tightens, lease rates rise. 5%, 10%, higher. Because borrowing becomes harder. Watch Shanghai's premium. If the premium widens, it means physical demand is accelerating. If it narrows, it means balance is returning. And most importantly, watch delivery notices. Because delivery notices reveal the truth. How much metal is actually demanded, not traded, not speculated on, demanded. The fundamental question. The market must answer. Right now, 2 prices exist. The paper price and the physical price. For years, those prices moved together. Now they are separating. Shanghai has revealed that separation clearly, and delivery deadlines will determine how that separation resolves, because paper contracts represent promises. Physical metal represents fulfillment. And when fulfillment becomes uncertain, price adjusts, sometimes gradually, sometimes suddenly, but always eventually. The final reality. The Shanghai reopening was not just another trading session, it was a signal that physical demand remains strong even after aggressive paper selling, a signal that premiums are expanding, a signal that supply and demand are tightening. And with first notice day approaching, the silver market is approaching a moment of truth. Either delivery demand remains manageable and the system stabilizes, or delivery demand accelerates and the system enters a new phase, one where physical supply becomes the dominant force driving price. Not paper positioning, not short-term speculation, but physical availability. Because in the end, every futures contract must answer the same question. Will it settle in paper or in metal? And in the coming days, the market will reveal the answer.